In this recording, we're going to look at question 6 in your pack. Look at particularly just an introduction to the translation of a foreign operation. In particular here, we're looking at foreign subsidiary. So we're really only looking here at FX difference 1 and 2. We're not going to worry about goodwill. We're not going to worry about fair value adjustment. We'll deal with them in subsequent questions. This is just the basics of how do we translate a P&L and a statement of financial position from, in this case, dollars, a foreign currency, into euros. So you're given corn, you're given a company was set up at the start of the year, 200,000 ordinary share capital, and 12 months later you're given the financial statements. So there's your dollars financial statements, 300,000 profit, and there's your statement of financial position. You can see the $200,000 share capital, and there's only retained earnings of 300, which matches here, because the company was only operating for 1 year. I was trying to keep it as simple as possible before we move on to harder ones. And then you're given exchange rate at the start of the year, the end of the year, and the average for the year. And we're asked, prepare the following for corn on the basis that euros is the presentation currency. So we need to translate from dollars to euros, because we might be using that as a subsidiary for another euro-based group accounts. So again, go back and look at the rules for IAS 21 in your slides. So what the closing rate method is, you translate all assets and liabilities at the closing rate. So for example here, all the assets and liabilities, they're going to be translated at 5:1. So you're going to divide all of them by 5. The income and expenses, they are going to be at the average rate, which is 4:1. So the P&L is actually going to be translated as 4:1. So you can see where there's a mismatch here. Some of this is going to be translated as 4:1 because that 300 is actually coming from up here. So that's translated at one rate. The assets and liabilities are translated at another rate. And the ordinary share capital and any pre-acquisition reserves. Now the pre-acquisition reserves here, they are the reserves at the date of incorporation in this case. Now in other questions, it will be at the date of acquisition, but we're keeping it simple here. So the only thing we're interested in is the 200 is actually going to be at what we call the historic rate, HR, which is 3:1. So because we have a balancing statement of financial position, but because we're translating them at different rates, you're going to have a plug figure. And that plug figure is going to be made up of your FX differences. So we're going to work our way through it to see. So I've just copied over the financial statements and we're going to use our exchange rates. For the P&L, it's going to be the average rate. All right, so we'll just tidy up all this so we have it all at the same. We'll use Calibri. And we'll do 40. So the average rate here is 4. So you're just dividing everything by 4 to get your P&L. So that means your euro P&L, and we'll just put that here in euros, is going to be this divided by 4. So there's nothing more complicated than that, and you bring it the whole way down along. And we'll just tidy it up to make sure it matches. So some of these are straightforward. Now, in an exam question, you will have other adjustments, but for now, that's how you translate it. And that'll probably be one working as you're bringing into a bigger question. Any income and expenses, which we have here, they are going to be translated at the average rate, which will be given in the question. And the average rate there is 4:1. Assets and liabilities are going to be translated at the closing rate, 5, 5, 5, and 5. So in terms of corn for euro here, that is going to be 270. That is 40, gets you to 310. And your liabilities, 750 divided by 5 and 300 divided by 5. So there is a lot of rules based here, but it's important that you understand what's going on. You then do your pre-acquisition retained earnings. They are going to be at the historic rate, which was the date in this case of incorporation, and that we're told was the 1st of January, which is 3:1. And then I always leave this figure as a plug. So this one here, the approach I always take is a plug figure, and we'll explain why in a second. So that's going to be 200 divided by 3 is going to be 67. So we need total equity and liabilities to be 310 as well, because total assets must be 310, total equity and liabilities must be 310. So you're actually going to back into the answer here. So we're saying what retained earnings figure is going to make the equity and liabilities balance with the assets. They do balance in dollars, but when you have different rules for different items, they're not going to balance in euro. There's going to be a plug figure, and then we're going to come down and break out that plug figure and figure out what's in it. So that plug figure here is going to be 310 minus the 67 minus the 150 minus the 60. So your plug figure there is 33. Now there's three things in that. Right? And that's important because you need to practice this for subsequent ones. What will be in retained earnings when I convert it? Well, what's in the plug? The plug consists of, number one, pre-acquisition retained earnings at historic rate. So that's the first thing that's in there. It's any retained earnings at the date of acquisition. Now in our case we'd have nil, but the principle will hold for every other question. What was retained earnings there, and convert them at the historic rate. So in our case here, it is 0 divided by 3, which equals nil. So we have none because we don't have any pre-acquisition retained earnings. We set it up at the start of the year, which means it had 0 retained earnings. All those 300 retained earnings came from this year. The second thing that's in there is post-acquisition retained earnings at rate when earned. So anything that's post-acquisition, you will convert them at the rate when earned. What we mean by that is you convert it at the average rate for that year. Now it's simple here because we only had 1 year retained earnings post-acquisition, and that means we only had one average. But if you, for example, had a subsidiary that was acquired 2 years ago, you'd have 2 separate profit figures here and 2 separate average rates. But for us here, it's a straightforward 300 divided by 4 equals 75. So the plug figure is made up of that as well. So they're quite straightforward. In every retained earnings figure, you always pre-acquisition and post-acquisition. But that 75 doesn't equal the 33. So the last thing, and this is new, is your cumulative FX differences. And this is what we covered in class FX 1 and 2. So these are the differences that are always going to be in every question. You may have FX 3 and 4. We'll get to those in terms of goodwill and fair value adjustment. But for now, we're going to say this must be minus 42. And that is a plug figure. Because 75 minus 42 gets me to my 33. So you're backing in what must the FX differences be. Now we will prove them in a second, don't worry. But for now you must show, well, in there now must be retained earnings, which is going to be shown separately. And then cumulative FX differences is going to be shown separately as well. So actually what's going to happen is you're going to be splitting out this, and you're going to say retained earnings is going to be 75, and you're going to say FX differences, because it has its own line item in the equity section, is going to be minus 42. And I'll just tidy that up so it's obvious that that's a minus. So that's the way it's going to be presented now. Instead of having that minus the 33 as a plug, that's only kind of a temporary working. It'd actually be shown ordinary share capital 67, FX differences 42, retained earnings 75. Right. So that retained earnings matches the retained earnings up here. That's only because it's a simple 1 year post acquisition. Right. But we'll come and we'll finish the P&L in a second as well. So that's your second step, is you get what the FX differences is. And they're made up of two things, FX difference 1 and 2. And we'll prove them just to show, because you should be able to calculate them as well. Because technically where that's arising from is, because you're converting assets and liabilities different to what you're converting the income and expenses at, and different than what you're converting open net assets at, you're going to have a difference in FX. In this case, you have an FX loss. So to prove that, we will look at FX difference 1, which is due to net assets. In this case, opening net assets. So to explain this, you're essentially saying my opening net assets worth $200,000, which is the start of the year, the date of acquisition. Right, so opening means the date of acquisition. That could be 3 years ago, could be 4 years ago. For this simple one, it is the start of this year, just to make it straightforward. So my opening net assets are in dollars 200. Okay. Now the key thing to note here is in the balance sheet, in the statement of financial position, they are converted at the historic rate. That's the rule. But everything else, the assets and liabilities, which essentially are the same thing, just look from a different perspective, they are at the closing rate. So there's a difference there because things are done at different rates. The historic rate is 3, the closing rate is 5. So that means this is 67, now I round it, whereas this would be 40. So that is an FX loss of minus 27. So that's important that you understand that, and that takes a bit of time. The rules under IAS 21 say when you're converting particular line items, particularly opening net assets, we've no retained earnings, we just have the share capital, you have to convert that at the historic rate, which happens to be here the 1st of January. But if everything else in the statement of financial position is converted at the closing rate, there's going to be a difference there. And that difference is going to be part of that plug figure. So the difference there is because you're changing now at 5 instead of 3, you're going to have an FX loss to balance things up of 27. So that is FX difference 1. FX difference 2 then relates to your profits. Profits post acquisition. Now in our case here, we have a nice straightforward one. We only have 1 year post acquisition profit. And that is, as we've seen already, $300,000. If you had more than 1 year post-acquisition, because you acquired the sub 2 or 3 years ago, you have 2 or 3 separate workings here. So it is a bit more complicated. In IAS 21, they are converted at the average rate, whereas everything else is converted at the closing rate. So there's invariably going to be a difference there between 4 and the 5. Converted at 4 gets me to 75. Converted at 5 would only get me to 60. So because we have that difference in the two sides of the statement of financial position, that's going to create an FX loss as well. And that loss is going to be 15. So that is an FX difference 2, which is a loss. So the total FX difference, which is a loss in this case, is your minus 15 minus your 27, which matches with the plug figure that you've done. Now it's not enough in the exam just to give me the plug figure and hope it's correct. You have to prove where it's coming from, so you understand the 2 key differences, and they will be in every exam question in terms of foreign sub. You may have other ones, FX difference 3 and 4, which we'll get to in other questions, but understand the basics first. If I'm converting my opening net assets at the historic rate and everything else at the closing rate, there's going to be a plug figure. And if I'm converting my profits post-acquisition at the average rate and everything else at the closing rate, there's going to be a difference there as well. And that plug figure here matches the proof of it here. So technically what happens with a foreign exchange difference, unlike individual transactions, FX differences in terms of translation differences, which these are, because you're translating a subsidiary's account into euros, they go to OCI. So they go to a separate section, that's why there's a separate line item, and that will have its own line item in the equity section. So therefore, technically, in your P&L, you're going to have a new section, and it's going to be called Other Comprehensive Income. And you're going to call it FX Losses, and then you're going to have minus 42, which is total comprehensive income, will be your 33. So that's where the 33 comes from, but it's just important that you understand the differences as you go down along. You understand where the figures come from, number 1, and you realize this is a very straightforward example where you have no opening retained earnings, number 1, which makes it quite straightforward, and you have only 1 year post-acquisition. As we build on the next couple of questions, we'll be doing the same approach, but it'll be a bit more complex, because we'll have a number of years and we may have some goodwill calculations to put in. But for now, you just focus on getting the basics of how do I apply those rules and how do I reflect the FX differences in the financial statements. All right. So that was an introductory question, question 6, Corn Limited.